about the fact that everyone is starting to settle in and realizing this is not a quick conflict. This is going to go on for a long time.
If you wanted to change the math, the Fed could do it. You could point to a different indicator, but they haven't. They've been very simple in their, maybe they've been overly nuanced at times. But the idea is it takes a long time to stop inflation. It's psychological. The only way to do it is to make cash rates very attractive, invert the yield curve, and wait. And so for all the noise since October, I'm not sure that a lot has really changed.
Well, cash is attractive, and the yield curve is inverted, that's for sure. Bram, we enjoy it, as always, to catch up with you, sir. Bram Eisling, Morgan Stanley Investment Management. Bit of a clinic there, TK, on fixed income and some of the opportunities for everyone right now.
Really, really important, John, and I can't say this enough, folks. Weinstein is hardcore. This is a Morgan Stanley tradition of looking at level, of looking at individual bond versus spread.
Look, I think part of the problem is crude oil specific fundamentals are not particularly strong. We've built a ton of inventories, we've had the bad weather, we've obviously had, or we do have right now, a lot of refinery maintenance, and that's why right now crude is pretty much at the mercy of, exactly like you're saying, the bonds and the equity markets. And this is why the 6 sessions we've seen that's been trending lower, and this is something we called for just recently as well, that crude is probably going to be at the mercy of macro headlines. And by the way, now even good news is bad news. You would think, strong labor market in the US is actually really bullish for gasoline demand. But guess what? No, now the fears are that means the Fed's going to raise interest rates. What does it mean for the future of the US economy? So it is very, very problematic for crude until fundamentals pick up.
Well, I guess my contrary instincts came out at the beginning of the year. Everybody was talking about a recession. Some people said it's 100% inevitable. And they had some data supporting them. The Index of Leading Economic Indicators, which has an awfully good track record of forecasting recessions, has been screaming a recession since it peaked in February of last year. And typically it gives you a 1-year lead time. So we should be in a recession right now, and it's just not happening. But I also looked at the consumer, and the consumer data just continue to show that you don't want to bet against American consumers when they're well, let's put it this way: when they're happy, they spend money. When they're depressed, they spend even more money. Well, I think that prior to the release of the January's batch of no landing indicators in early February, I think we were mostly debating. All of us were mostly debating whether it was going to be a soft landing or a hard landing. Nobody really had to spend much time talking about no landing. No landing, in my mind, means that the economy is growing 2.5%. Maybe more this year. The soft landing, I think, is more like 0.5 to 1%. The hard landing is a traditional recession with negative numbers of 1, 2, 3, 4%. And I think that's what's changed. And that kind of, as you said, that gives you, promotes the no landing scenario to something that we need to debate. And there's actually 2 versions of that. There's the inflationary one, which I think is what the market suddenly started to worry about. And then there's the disinflationary one, which I think seems like a stretch, but I think it's possible.
You are right to ask that question. In fact, first of all, we should just recognize that the employees of Stellantis starting in North America have done a stellar job in 2022, facing all the external headwinds that they had to face. Now, to your question, in the near future, it's going to be an exciting period where everybody is going to try to hold on to a significant pricing power, despite the rebalancing between supply and demand, which is, of course, ongoing and already there. So that rebalancing on supply and demand will put pressure on the pricing. But on the other side, because of the interest rates, we see some cooling in the economy that will bring more cost reduction on some of the raw materials, eventually starting with steel, which means from one side, pricing power is going to be under pressure, but you have the technology, you have the appeal of the products, you have the new models that are coming in. And from the other side, you need to run fast in reducing the cost at a faster pace than the erosion of pricing power. That's going to be the name of the game for the next year. And we are in the race. We are in that race. And I think that we'll see within 1 year who is going to be the winner of that race. But that's exactly how things unfold in front of us for the next quarters.
So now, as you say, with yields considerably higher than they had been. And I think, we've seen over the last few days again that the market is continuing to really focus on where the terminal rate might be in the US and elsewhere. Also, how long rates will remain elevated for a prolonged period of time. Also, when you look at the level of cash and what you can get for that as well, the decision for investors really is looking at the carry that you can get in your portfolio, the income to match your liabilities, the interest rate and duration risk, and how you can really get returns that you want and the income that you want. And this is versus cash, not versus risk assets anymore. So when you're looking at the risk-free market, when you're looking at the bond market, it's really focusing on getting very high quality, decent carry and comparing that to what you can get for cash and ensuring that you really are getting the returns that you want.
Well, I wouldn't even say they're doing better than good, because when you think about the situation we're in, we do have economic strength. We had economic strength in January, and the preliminary PMIs reported yesterday look like it's carrying over to February. And we still see, basically hot economic data, still high inflation levels. But on the flip side, you have Home Depot and Walmart yesterday say earnings going to be down year over year this year. So you're looking at an environment where the Fed does need to be tighter. We only just moved to a positive real Fed funds rate earlier this month, and we still have an inflation problem. So you're looking at a policy outlook that's just going to be very unfriendly going forward. And again, the fundamentals for companies are, they're slowly deteriorating, I guess is the best way to describe it, but they're not improving.
Every time you had a bout of inflation, money growth accelerated 10, 15%. And so it was an easy connection in that regard. Then getting to today, bank deposits, which are 85% of the money supply, are a practical way to track it every week. And they have declined significantly. They're down about 2% now, and they've declined $100 billion in the past 2 weeks. This is going back to the 1930s to have a situation like this. Now, we found over a decade that the money supply might not have much of an impact if it's in a normal range, say 5 to 10%. I think Margaret Thatcher found that out when she was trying to gear monetary policy with Friedman off of swing the money supply. But last year, the money supply increased almost 30%. The year before that, government outlays increased 50%, and the Fed monetized it. And now, M2 last week was minus 3%, which is a ominous or significant decline. And it leads by 1 and 2 years. So it you can't see it on the program you have this morning, but it's coming, and I think it shows up in some of the slowdown of inflation readings we're seeing now, like container freight rates. Lisa, I think they'll export. Once they get the factories going, I think they'll be an increased source of exports. Just recently, they became the biggest exporter of vehicles. And so I think they'll do that. I think they're going to push up commodity prices like copper, but then come in and push down finished goods prices. I will say that I'm watching most closely the price of oil. And that is my North Star as to how China is progressing right now. And oil prices, which I look at on Bloomberg practically all the time, they're pretty quiet right now, around $75 for West Texas. And so that tells me that China hasn't gotten ripping ahead yet. So I think that's coming. I think oil prices will go up.